What do we do when the market starts crashing? That's really the age old question when it comes to finance. So, for today's tip of the month, what I'm going to focus on are 4 or 5 actionable things that you can do to do the most important thing in a downturn, and that's take advantage of them. I would love to sit here and say we can do things to like get out right before markets go down. That's rather impossible. So, again, it's not that we can avoid it, but we can certainly take advantage of it. So, let's go through a scenario. We are now extremely fortunate to be sitting very close to all-time highs. This is a fantastic time to sit, look at your plan, and see, well, based on my new account sizes and the goals I plan for my future, what do I need rate of return wise to live the lifestyle that I want? You might have found yourself in a situation where we can dial back the risk without really sacrificing that much return or that much lifestyle. So, again, first thing you do when markets are at all-time highs is check your plan, see what we need to do to accomplish our goals. The second is just give yourself a good gut check in terms of the risk tolerance you're willing to take. And what I always like to do is play out a worst case scenario. So I'm sitting here with all-time highs. Let's say you did a fantastic job and you got $1 million in your 401k and you're in a 50-50 portfolio. Well, if we ran that scenario through a 2008 type downturn, it might be a situation where within a year and a half, we're down 300,000, 350,000. You might be sitting there and saying, considering my new size and how much that would fluctuate, I'm not really comfortable with it. So just running hypotheticals when we're sitting at an all-time high, you couldn't ask for a better time to do it. So let's say, all right, I've decided to leave my investments where they are. I'm comfortable, even if a downturn comes, that I will ride out the storm. Which leads me right into the first thing you have to do is stay calm. Stay relaxed. If you have a broad, diversified portfolio and you stay calm, it's been 10 times out of 10 that we've gone through a downturn that you went back to all-time highs. Give it enough time. So first thing, stay calm. 2, we want to look to take advantage of the downturn. So what that could mean is, let's say you're 60% in stocks, and as markets are starting to go down, and let me put some rough numbers behind that, 0 to 10%, those are garden variety corrections. I don't know if I'd be doing anything in terms of tweaking my portfolios too much in that type of scenario. But once you've gone down into the 10 to 20% downturn, that's normally a pretty good entry point to start taking advantage of it. So it might be a shift of maybe 4 or 5% from maybe the bond side of the portfolio over to the stock side. Now, as markets continue to go down, and if you can stomach it, these are really where the opportunities may lie. It's kind of counterintuitive, but if you went to the mall right now and you saw a 10% sale, you wouldn't do anything. But if you saw a 30-40% sale, you might be more inclined to buy. When stocks go down 20, 30, 40%, everyone runs away. These are buying opportunities that come around maybe once every 5, 6, 7, 8 years. So if you can stomach it, as markets are going down, most of the time the beneficial thing to do is continuing to nibble, continuing to take advantage, increasing our exposure to stocks as markets are going down. So that's on the stocks and bonds side of the equation. Another thing we can look to do to take advantage of a downturn is what's called tax loss harvesting. So this is a scenario, maybe some of the positions inside of a taxable account are at a loss. So what you can do is sell a position at a loss to take a tax deduction. And in saying that, you may be concerned, well, Mike, I sold out of it. What happens if it starts to rebound? What a lot of times you can do, let's say if you have a US stock fund, buy a similar style fund. So this way markets go up, you still get that exposure, but we get to take advantage of the tax deduction by processing a sell. Another great thing you can do is look to see if a Roth conversion makes a lot of sense for you. In the perfect world, I love processing Roth conversions if markets are down and I'm in a low income reality, a low tax bracket. So 1 out of 2 is not bad. So if we're sitting here and markets are down 20, 25%, maybe doing a small to mid-size Roth conversion is a good idea. Another thing you can do is increase your contributions. So you want to think about it is, I get to buy stocks on sale 20, 30%. If you're putting 6% towards your 401k, maybe for a period of time, you increase that to 7, 8% because because you're getting to buy stocks cheap. You know, these are a few things you can do to really take advantage of a downturn. Now, if you have any questions or if you're curious about if any of these strategies make sense for you, always feel free to reach out to me.